Over the year 2025, AI-related enterprises accounted for roughly 80% of gains in the American stock market. 80%. Let that sink in. But here's what nobody's telling you. In late 2025, 30% of the entire S&P 500 was solely held up by just 5 companies. That's the greatest concentration in half a century. And according to experts, share valuations are reportedly the most stretched since the dot-com bubble. If you're an SCHD investor feeling the pain of watching it sit flat while everything else rockets up, I need you to understand something critical. You're not wrong. You're early. And what I'm about to show you could be the most important portfolio decision you make heading into 2026. I'm Andrew. I spend hours researching dividend stocks and market trends so you don't have to. But here's the deal. Everything I share is educational, not financial advice. Investing involves risk. Do your own research. I'm not a financial advisor. Here's the uncomfortable truth SCHD investors are facing right now. The year-to-date return on SCHD is sitting at just 5.28%. Meanwhile, the S&P 500 just notched its second consecutive year of 20% plus returns. And I know what you're thinking. Did I make a mistake? Should I just give up on value investing and chase the AI rally with everyone else? Before you do that, let me show you what's actually happening beneath the surface. Because what looks like SCHD underperforming is actually your portfolio being positioned exactly where smart money is starting to rotate. Michael Burry, the guy who made hundreds of millions betting against the housing market in 2008, is now betting against Nvidia. Jamie Dimon, head of JP Morgan, just said there's a higher chance of a meaningful drop in stocks over the following 2 years than the market is currently reflecting. The Bank of England warned of growing risks of a global market correction due to possible overvaluation of leading AI tech firms. This isn't doom and gloom. This is pattern recognition. And the pattern is screaming one word: rotation. A rotation into value stocks from growth could grow stronger in the new year. In fact, CNBC just reported this just a few days ago. Value stocks have enjoyed a late-year resurgence after underperforming earlier in 2025. And here's where this gets really interesting for you. Because while SCHD has been the standard bearer for dividend value investing, there's another fund that's been absolutely crushing it during this exact rotation period. VTV, the Vanguard Value ETF. This year, VTV is up 12.65% while SCHD is up 2%. But before you think this is just about swapping one fund for another, what I'm about to show you is how to use both strategically to position yourself for what could be the biggest value rotation in a decade. BlackRock strategists recently highlighted a compelling case for large-cap value stocks going forward. The rationale: as the economic cycle matures, companies with strong fundamentals, stable earnings, and reasonable valuations could outshine the ultra-expensive growth names that dominated the AI boom. Here's the aha moment that changes everything about how you should be thinking about your portfolio right now. Everyone's been asking the wrong question. They're asking, should I invest in SCHD or VTV? That's binary thinking. That's the amateur approach. The professional question is, where should each of these live in my portfolio to maximize after-tax returns while positioning for the value rotation? And this is where most YouTube videos and most investors completely miss it. Because the answer isn't about which fund is better. It's about tax optimization and strategic positioning. Let me break this down in a way that could literally save you thousands of dollars. VTV has a dividend yield of about 2.1%. SCHD has a yield of around 3.8%. Now, in a taxable brokerage account, every time you get that dividend, Uncle Sam wants his cut. But in a retirement account, an IRA or 401k, those dividends grow tax-deferred. So here's the play. If you're building serious wealth in 2026, you put your higher dividend payer, SCHD, with its 3.8% yield, inside your retirement accounts where it can compound without the tax drag. And you put VTV with its lower 2.1% yield in your taxable brokerage account where you're getting value exposure with less tax consequence. That's not just smart. That's how wealth is actually built. Now let me show you why these two funds are actually perfect complements for the rotation that's coming. VTV tracks the CRSP US Large Cap Value Index. It's pure value exposure across 300-plus holdings. Broad diversification. Low expense ratio of just 0.04%. It's designed to capture the entire large cap value universe. SCHD tracks the Dow Jones U.S. Dividend 100 Index. It's specifically filtered for quality dividend payers with strong cash flow. About 100 holdings. More concentrated. Slightly higher expense ratio at 0.06%, but that's because you're getting quality screening. Think of it this way. VTV is your broad value safety net. SCHD is your premium dividend engine. Here's what makes this powerful right now. The overlap between the two funds is only modest. Just 12% of VTV's holdings by number are also in SCHD. That means when you own both, you're getting true diversification within the value space itself. Looking at sectors, both funds are keeping tech exposure incredibly low. Exactly what you want when the Bank of England is warning about AI overvaluation. VTV has strong exposure in financials, industrials, and healthcare. SCHD's top three are energy, consumer staples, and healthcare. And here's the kicker. VTV's top holdings include JP Morgan, Berkshire Hathaway, Exxon, Walmart. These are the companies that benefit when rates stabilize and the economy keeps chugging. SCHD's top holdings include companies like Merck, Amgen, Coca-Cola, recession-resistant, dividend aristocrats. You're building a fortress of value with different defensive positions. Now here's why this matters specifically for 2026. Dennis DeBouschier, chief market strategist at 22V Research, just wrote that if the Federal Reserve lowers interest rates in the first half of 2026 and AI boosts worker productivity, we could see the economy grow at 2.5% real without inflation being a problem. And he said, quote, "That is a tailwind for fundamental factors and procyclical equities." Translation, value stocks are positioned to run. Charles Schwab's 2026 outlook just highlighted that they expect ongoing rotations with greater participation under the surface of the market. They specifically called out an up-in-quality bias, with emphasis on profitability, balance sheet strength, and reasonable valuations. That's SCHD. That's VTV. That's exactly what we're talking about. And get this, Bank of America's technical strategist Paul Sienna just said the Dow Jones Transportation Average breaking to new highs in 2026 could confirm a rotation in sector leadership and an improvement in market breadth. Everything is pointing to the same conclusion. The AI boom created the bubble. The value rotation is creating the opportunity. So here's exactly how I would deploy this strategy heading into 2026. First, assess your current exposure. If you're sitting 30 to 40% in growth and tech, it's time to trim 10% off the top and move it to value. Not because growth is dead, it's not, but because concentration risk at these valuations is real. Second, use the tax optimization strategy. SCHD in retirement accounts for maximum compounding of that 3.8% yield. VTV in taxable brokerage for value exposure with lower tax drag. Third, and this is critical, don't try to time this perfectly. RBC Capital just said in their 2026 outlook that investor nervousness is leading to rotation out of the market's biggest growth names. That rotation is happening now. Not next quarter. Not next year. Right now. If you want more value exposure but you're torn between the two, here's the framework. Choose VTV if you want broad, diversified, large-cap value exposure with minimal sector concentration, and you don't need the income right now. Choose SCHD if you want higher dividend income, you're building a retirement portfolio, or you specifically want quality screen dividend growers with a track record. Choose both strategically if you understand that true wealth is built through complementary positions that work together, not binary choices. Fourth, consider the 60-40 rule differently. Instead of 60% stocks, 40% bonds, think about having 40% growth, 40% value, 20% alternatives or bonds. That rebalancing alone could position you to capture the rotation without missing growth entirely. Now, I know some of you are thinking, but what if AI stocks keep running? What if I rotate into value and miss another 30% gain in tech? Fair question. Here's the answer. Goldman Sachs CEO David Solomon just warned of a likely 10 to 20% drawdown in equity markets at some point within the next 2 years. Not if. When. When that correction comes, what do you want to own? The stocks trading at 50x earnings that need perfection to justify their valuations? Or the stocks trading at 18x earnings with real cash flow, dividends, and balance sheet strength? The goal isn't to catch every rally. The goal is to build wealth that survives every correction. Look, I've been investing long enough to know that the hardest moves to make are the ones that feel early. Buying value when growth is screaming feels wrong. It feels like you're leaving money on the table. But here's what I know from history. Every single market bubble has ended with a rotation back to fundamentals. Every single one. The dot-com bubble, the housing bubble, and whatever we're calling this AI bubble 10 years from now. The only question is whether you position yourself before the rotation or after. SCHD gave you 29.87% in 2021. It's sitting at 5.28% year-to-date in 2025. That's not failure. That's compression. That's the spring loading before the release. VTV is already showing you what that release looks like. Up 12% this year while growth struggles. You don't need to abandon growth entirely. You don't need to go all in on value. You just need to be strategically positioned for what comes next. Because when the music stops, and it always stops, you want to be sitting in the chairs that everyone else is scrambling to find. Make the move now, while it still feels early. That's how generational wealth gets built. To keep learning and stay ahead of the market, check out these videos.